If you're a business owner and you feel like you're overpaying in taxes, you probably are. Not because you want to, but because no one has shown you exactly what strategies are available to you to help you reduce your tax bill. The good news is that as a business owner, the IRS gives you an entire playbook on how to reduce your taxes called the tax code. The problem is most people don't know how to use it. If I haven't met you yet, my name is Kyle Glenn. I'm a certified financial planner and exit planning advisor. So in today's video, I'm going to walk you through 4 concepts that will directly impact your tax strategy if implemented correctly. And these are not loopholes or aggressive applications of the tax code. This is just using the tax code as it is written. And if you want a deeper dive into how your taxes are actually reported on your 1040, I've actually made a separate video of that. But let's stick with the strategies for now. The first one is benefit programs. This really is the lowest hanging fruit. This is retirement plans and health insurance programs, mainly to help attract and retain good quality employees. But in reality, you're creating an expense to be able to get a deduction off of your business tax return. So the real question becomes, what strategies can I implement without just creating more expenses? That's where the next 3 come in and can be very impactful for you. The second one is entity structure. Many of us business owners will start off as a single member LLC and begin to make a profit. But if you continue in that entity structure, all of that net profit is subject to 15.3% of self-employment taxes. I had a client who structured himself as a single member LLC and began to make a significant profit on an annual basis. So we restructured him to an S corporation. He still got his W-2 wages, but all of the remaining profit was taxed as a dividend, bypassing that 15.3% self-employment taxes. But the question is not, should I switch this over? It's when does the tax savings create more benefit than the additional costs of switching to an S corporation? Because there will be payroll and tax filing expenses that add up for S corporation owners. So your net profit does need to be at a certain point before it makes economical sense for you to switch. But for some owners, this can save thousands of dollars in taxes on an annual basis. Now, building on that, here's another way income can be shifted and how it is taxed. And that is third, owning the real estate your business operates on. And that can be held by you personally or through a separate LLC. But real estate income bypasses that self-employment taxes and is subject to the federal and state tax income. So if you're a single member LLC where the S corporation strategy doesn't make sense for you yet, owning the land underneath of you will be able to bypass that self-employment tax by funneling profits to a real estate holding company. And finally, the last one I want to talk about is lesser known. It's called the Augusta Rule. The IRS allows you to rent out your personal residence for up to 14 calendar days per year without reporting that income to the IRS to be taxed. So instead of holding your leadership team meetings at your office, hold them at your personal residence. Your business can write it off as an expense and you can receive that income tax-free to you. Now, this does need to be done properly. It does need to be a real business meeting with a real purpose that is documented. And the rate that you pay yourself for your residence does need to be a fair market rent. But if implemented correctly, this is a clean strategy. All 4 of these concepts are to help you start thinking differently on how your income is taxed. If you're not sure which strategy actually applies to you, don't guess. That can create a headache more than it's beneficial. So click the link below, schedule a time with me, and I'll walk you through your situation. If you've enjoyed this content, please like and subscribe to the channel. I'll see you in the next one.